Happy New Year and welcome back to AIADA's Auto Talk. I'm your host, Rachel Soleimani. Since today's program is a special alert, it will run a bit longer than our other programs. Because of this, we will be unable to hold a live Q&A. However, feel free to enter your questions into the Q&A bar, and I will pass them along to our presenters to answer offline. Now join me in welcoming back our friends from Moss Adams, Tax Senior Managers Brianne Eagles and Brittany Richards, along with tax partner Jack Baker. I know you all have some important information to share with us, so please take it away.
Thank you, Rachel. We're very excited to be here today. And before we kick off, we just wanted to do a quick introduction for ourselves, and then we'll jump right into the material here. My name is Brittany Richards, and I'm a tax senior manager out of our Portland location. I've been with Moss Adams for about 9 years now, and my primary focus is working with auto, truck, and RV dealerships and their owners. Brianne?
Brittany. My name is Brianne Eagles. I am a tax senior manager in our Medford, Oregon office. I also work primarily with auto RV dealers and happy to be here today.
Jack Baker. I'm a tax partner with the Pacific Northwest region. Primarily work with dealerships also. I'm also the partner in charge of our centralized inventory processing practice. About 20 years ago, we set up centralized auto LIFO processing. It took off a little faster than we expected, and pretty quickly we were doing the LIFO calculations for all of Moss Adams. We do auto LIFO, IPIC LIFO, internal index calculations, review a lot of client prepared internal index calculations, and we also do the electronic used vehicle booking for lower of cost or market for auto dealers. At this point, we have about 20 team members, and we do about 500 annual calculations. It's been a lot of fun to see it grow and how many calculations we do. It does make for a pretty busy January and February, but we enjoy the challenge. I'll turn it over to Brittany to talk a little bit about LIFO.
Awesome. Thanks, Jack. Well, we wanted to start off our discussion today with just a brief refresher on what LIFO is before we dive into the challenges and potential opportunities available in our current climate of historically low inventory across the dealership industry. So, the last in, first out method of valuing inventory is basically a tax strategy which is used to reduce inventory and then increase deductions to the taxpayer. It basically allows a taxpayer to expense inflation as their inventory builds and then deduct the inflation as an additional cost of sale in the current tax year. This tax strategy is a little different than most other tax strategies. So sometimes we refer to LIFO as a semi permanent difference for tax purposes, in that it doesn't necessarily reverse year over year like a normal, typical book to tax difference would. Instead, the tax deferral each year is added as an additional layer in the LIFO reserve and will continue to accumulate over time. In most, I'd say, normal years, and if we could see each other, I'd have some air quotes around normal years, as long as inventory levels remain fairly consistent and we're in an overall period of inflation, the LIFO reserve will continue to build and increase year over year. However, sometimes during times of deflation or significant inventory decreases, a taxpayer may actually begin recapturing some of that LIFO reserve that's built up over time, which in essence results in additional taxable income to the taxpayer. Okay, so now that we've refreshed ourselves a little bit on what LIFO is, let's dive into what we're seeing in today's climate, and I'm going to pass it over to Brianne.
So just like Brittany just said, when we see big decreases in our inventory levels, we can end up having to pick up some income. And so this is the issue that we're talking to all of our dealer clients, and beyond even our dealer clients. We're seeing this across industries where inventory is hard to get right now. And so we're seeing income reserve pick up, so income being recognized this year. But of course, don't have to tell all of you this. Dealers have been hit definitely way more than a lot of industries because of the chip issues combined with the supply chain disruptions and all of that. So we're definitely seeing this hit dealers a lot this year and having a lot of conversations about this. So when we see these large reductions in inventory, we always get concerned that we're going to see a big pickup in income from the recapture of the LIFO reserve. We have been talking about this now since probably toward the end of 2020. So we really expected that last year's reductions in inventory were going to result in big pickups in income, but we didn't actually end up seeing that like we expected. What we ended up seeing was the LIFO reserve pickup was only really going back to these low inflation years. So 2009 to 2019, where we saw dealers building on their LIFO reserve every year, but the inflation was fairly small. So we weren't seeing really big pickups in deductions over these years. So what we saw at the end of 2020 was for most dealers, we ate back into those layers, those accumulations of annual LIFO deductions, but they weren't massive amounts. This year, because we're seeing even more or even less inventory on hand, we're actually seeing dealers pull in those really old LIFO layers that were much larger, that were in higher inflation years, and that's where we're seeing some of our LIFO reserves get fairly depleted this year because of the reduction. So, and again, this is going to depend on your specific circumstance, but on average, on all these calculations that we're doing, we're seeing most dealers have a large recapture for 2021.
All right. So at this point, I'm sure most, if not all of you, have heard some talk or buzz around the potential for LIFO recapture relief that could be coming from the IRS. But what does that actually mean? So essentially, there is a provision in the Internal Revenue Code under Section 473 that could be enacted to provide relief to taxpayers in times of qualifying inventory disruptions, which ultimately results in involuntary liquidation of the taxpayer's inventory. For Section 473 relief to actually be available to taxpayers, the U.S. Treasury would need to issue what's called a notice of determination in the Federal Register, basically stating that a qualified inventory interruption of LIFO inventories has indeed occurred and would then allow a holiday, if you will, on the significant LIFO recapture that many of our taxpayers are currently facing due to the significant decreases in inventory levels across the industry. At this point, the U.S. Treasury has not yet taken action to enact Section 473. However, if the notice of determination is made by the Treasury, taxpayers may be able to postpone a LIFO recapture event until inventory levels return to more normal levels. Generally speaking, a taxpayer would need to replace their inventory to those pre pandemic levels over a period of 3 years. As Brianne mentioned, beginning in 2020, at the onset of the COVID-19 pandemic, the auto, truck, RV industries began experiencing these significant inventory reductions due to supply chain disruptions and shortages. Moss Adams, NADA, the AICPA, along with countless other lobbyists, have started to petition the IRS and the U.S. Treasury for LIFO recapture relief under this Section 473. And again, as Brianne touched on in a previous slide, and just want to highlight again, many taxpayers were anticipating having large recaptures in 2020, but for the most part, we really didn't end up seeing this happen in most cases. While inventory levels did significantly decrease year over year from 2019 into 2020, what we saw was that due to those large decreases from 2009 across the industry, which did prompt the LIFO recapture at that point in time, and then seeing fairly insignificant inflation rates between 2010 and 2019. This actually shielded most of our dealers and manufacturers from having those large recaptures actually occur in 2020. However, as inventory levels are continuing to decrease in 2021, we are now starting to see those large LIFO recaptures across the industry. At this point, the mechanics of how the relief process will actually work have not necessarily been determined. The AICPA, along with other lobbyists, are requesting that a simplified process for the recapture relief be available. However, even if it does require going back and amending tax returns to provide new LIFO calculations, our anticipation is that really the tax benefit will likely outweigh the cost to most, if not all, of our taxpayers. And so, just to give you a high level example on what the overall impact of LIFO relief could look like, I'm going to let Jack walk us through an example here based on a RAM dealership. So let's take a look here.
Thanks, Brittany. So we picked a Ram dealership just because the truck inflation is so nice this year. It looks like it's running about 8%. We didn't try and guess what the simplification would be if there is any. So we put together this little example. There is a couple of unknowns here. Probably the biggest one is when they say you can replace the inventory in the next 3 years. It looks like the code, the 473 code, is going to be at year end, so it's not any peak. It's at, if you're 1231, it's going to be 1231 of any of the next 3 years. This 473 was enacted in the 70s. It's never been implemented, so there's no regulations, no guidance. But if replacement means that your cost can be greater than the 10 million that we have shown at 2020, this example shows what's going to happen. And what we're going to end up with is actually a very nice pickup in inventory, because we're going to end up with a current year expense of 2,384,000. And then you're also going to not have the recapture from 2021. So when you amend the return, you're going to end up with about a 3,344,000 reduction in income. So I think what that shows is, even if we don't get simplification, if 473 is available, we believe almost all taxpayers on LIFO will end up doing the LIFO calculations again and amending their returns. The one thing we do think is it will be optional. So if you have a very small reserve, or there's a reason why you wouldn't want to amend, you don't have to go through the cost and the expense of that. I'll move that on over to termination of LIFO to Brianne.
Thanks, Jack. So we've heard a lot of dealers talking about what they're hearing, from their 20 groups or from various, just in the dealership community, about what they should be doing to potentially mitigate this big recapture that they may be facing. And one of the things we've been hearing a lot is that terminating LIFO might be the right answer. And while there probably are specific circumstances for certain dealers where terminating probably makes sense, there are several things to consider, because when we've been looking at our clients and really modeling these out, we have yet to really come across that one that really makes sense for them to terminate. And again, not that it doesn't mean that that situation isn't out there and that it doesn't make sense in certain circumstances, but there are some things to think about before you make that decision. So first thing is, upon termination, you are required to basically spread that income, that recapture amount that's going to come into income, over 4 years when you terminate. So that would mean 1/4 of your LIFO reserve will come into income on your 2021 return, and then the rest of it, 1/4 for the next 3 years. And while this may make sense, you have this big recapture event and you want to spread the income over 4 years rather than it taking a big hit in 1 year. If we do see increases in tax rates, if Build Back Better ends up coming back and getting passed, then you are looking at pushing income into potentially higher rate years. And I'll talk a bit about that in a little bit about what rates we could potentially be looking at. So that's something to take into consideration. There is an election to bring all of the income into the year of termination, but that's only if the income is $50,000 or less. And most dealers, their LIFO reserve is larger than that $50,000, so they're not going to be able to make that election. It's going to have to be spread over the 4 years. There's also the issue that once you've terminated your LIFO election, you're going to have to wait 5 years to potentially elect again. And that is the biggest consideration there, is that we are currently in some pretty high inflationary times today, and it's projected to continue at least in the near term. And so giving up the inflation, the deductions for LIFO inflation for the next 5 years could be missing out on some really good tax deductions in high tax years. So that's another consideration, is that being off of LIFO for those 5 years could potentially mean you're giving up tax deductions. It also potentially keeps you from being able to utilize the 473 relief that Brittany was just talking about. So if you've terminated LIFO, Jack was saying, we don't know exactly what the regulations are all going to say, but based on the current law, we don't think that if you have terminated your LIFO election on your 2021 return, that then you will be able to subsequently go back and utilize the 473 relief if we later get it. So something to consider, if the 473 relief would benefit you, that terminating your LIFO election may not be the right answer. There's been a lot of information swirling around LIFO, and I've had clients ask, well, if my reserve goes to almost to zero, does that mean that I've terminated my LIFO election? And just a reminder, it does not. Even if it goes all the way, almost down to zero, you're still on LIFO, and you still have the ability to then, like I was saying, in later years, when your inventory increases and we have good inflation, that you're going to be able to capture those deductions in future years. And the best thing about all of this is that we get to use hindsight in this situation now. So if you're a calendar year taxpayer, which most dealers are, if you're passed through, you don't really have to make this decision or make a final decision on this until September 15th, so the extended due date of your tax return. So definitely start planning now and start thinking about it now, but you have time. So we'll know, did Build Back Better pass? What's included in it? Are all of the things that we're worried about now included, or have they taken the teeth out of it? And the tax increases aren't really what we thought they were going to be. So we are going to have the benefit of watching that for the next several months and making informed decisions based off of that information. You don't have to make the decision today. So those rates, the reason why we're pretty concerned about terminating LIFO and pushing that income into the future years is that if everything that is in Build Back Better does end up passing, we're looking at some significant rate increases into future years. So if it's just the top rate, if we're just going from the 37 to 39%, that's not a big deal. The 2%, if you factor in time value of money, that doesn't really seem like that big of a deal. But if everything else that's in it also passes, that's where it starts to really add up. And this example is specifically for an S corporation because they are maybe getting hit a little bit harder than the others as far as increases go. So you end up with that 2% top rate increase, a 3.8% increase for net investment income tax that will be added. And then if we lose the qualified business income deductions for taxpayers making over $400,000 a year, that is effectively a 7.4% increase to their tax rate. So once you add all of those together, we're looking at a 13% increase in future years. So that's why the idea of pushing income into a year where you're paying a 13% rate may not be as desirable as recognizing more of it in 2021. And this number actually does not include the impact of the state loss of QID. So some states, and this isn't all states, but if you live in a state that doesn't require that you add the qualified business income deduction back to taxable income before you determine what state taxable income is, you're also going to be paying higher state rates if QID goes away. Another consideration is, if you're a dealer who has been on LIFO, doesn't want to be on LIFO, are you not getting much benefit for it? Are you with a manufacturer that doesn't typically have good inflation? Do you have fairly low inventories typically, but you've been on it for a while and you're looking at this as maybe this is my time to just go ahead and terminate and bring the income in, pay the lower rate. It may be a case where terminating seems really desirable. One thing I'd encourage you to consider is to, rather than just terminating this year and doing the spread, is potentially taking advantage of the fact that your inventories are lower. You're going to have a large recapture in 2021, and then terminate in 2022 or wait to terminate until 2022. And what that's going to do is you're going to reduce your reserve significantly in 2021, recognize quite a bit of that income in the lower tax rate year. And then next year, when you're ready to terminate, you're spreading far less of a recapture over 4 years, or maybe by then your reserve is small enough that you can elect to do all of it in 2022 or whatever makes sense at that point. But it's just a strategy to maybe take advantage of getting more income into the lower rate tax year rather than spreading it into these higher rate tax years. And I think we mentioned this, a few times in this presentation, but we can't reiterate this enough. If you are considering termination, even if you are, you should still book a LIFO estimate for 2021. And the reason for this is if you later find that you do not want to terminate and you haven't booked that LIFO estimate, you have a conformity violation. And so LIFO has certain rules around booking LIFO estimates if you are providing financial statements to outside users. And that includes the financial statements you provide your bank, the financial statements you send to the manufacturer. If you don't book a LIFO estimate, you do have a conformity violation and it can kick you off of LIFO. And so again, preserve your options. Just go ahead and book that estimate, even if you think you're planning on terminating today.
Awesome. Thanks, Brianne. So we've talked some at this point about the potential for recapture relief, talked through some termination pros and cons. So let's look at some possible LIFO opportunities. For taxpayers who are not currently on LIFO method of accounting for inventories, 2021 could be a great year to look at making an initial LIFO election. In 2021, inflation has been high in most industries, and really from what we can tell and what forecasts would indicate, we should continue to see high inflation in the future as well. For most taxpayers to consider making a LIFO election, inventory value should be around 2 million or more. So the greater the inventory, the more beneficial the election will typically be. For taxpayers who are already on the LIFO method, there also may be an opportunity to expand your current LIFO election in 2021 to include more types or categories of inventory. In a few minutes, we'll look a little bit more closely at inventory pooling and walk through a case study towards the end of the presentation to see what this looks like from a practical standpoint and what the ultimate tax benefits could be by expanding that LIFO election. Also, keep in mind that high inflation rates aren't necessarily isolated to just dealerships. We've also seen really good inflation for 2021 in other industries as well. Some of those include farm equipment and dealers and manufacturers, construction equipment dealers and manufacturers, as well as lumber and building materials, just to name a few. So, taxpayers in these industries as well would also be good candidates to consider adopting LIFO in 2021. And finally, for those taxpayers who are currently structured as C corporations, but have considered maybe making the switch over to an S corporation, it might be beneficial to explore making that S election this year because, in most cases, since inventories are at record lows right now, your LIFO reserve is also going to be much lower. So while the conversion from C corporation to S corporation would trigger a LIFO recapture and require picking up some additional taxable income, the impact at this point would be more minimal this year than maybe it would historically have been. So keep in mind as well that the built-in gains tax would still apply to the LIFO reserve at conversion.
So with the strategies that we're going to be talking about here in the next few slides, a lot of them are around pooling, and so we just wanted to do a quick refresher of what pooling is and how it applies, especially to dealerships. So when we talk about a LIFO pool, it is for each pool, it is a separate LIFO calculation, and so the one that dealers deal with the most is a car pool versus a truck pool. And so when you have two separate pools, you actually are doing two separate LIFO calculations. So back in 2008, RevProc came out that allowed us to combine those pools. And so we no longer had to have a separate truck pool and car pool. We could combine those. So there is a chance that if it hasn't been advantageous in the past, that you may still be on two separate pools. And if you are, this might be the year to consider combining those pools. And what happens is, and what we saw this a lot last year with some of our dealers, is they maybe weren't able to get trucks, but they were able to get cars. So their car inventory had increased, but their truck inventory had decreased. By combining the pools, we were looking at the inventory as a whole rather than trucks and cars separately. And so it minimized some of the impact of the decrease of the trucks by the car inventory offsetting those decreases. So it is one strategy if you do happen to be on the two pool method to consider to mitigate some of that. Last year, like I said, we saw reductions, but sometimes it was just a more of a mix issue, whereas this year we're seeing just overall decreases significant. So something to consider. Another another thing is the using the IPIC method. So most dealers are on what we call auto LIFO. The IPIC method is what IPIC stands for, is Inventory Price Index Computation. It's a different method of applying LIFO. And with the 2-digit category code, we can use a single pool. And we have an example of this coming up that we can explain it. But where we see this often is, our RV dealers, our boat dealers, they're on the IPIC method, and we're able to use a single pool for all of their inventory. So they're used, they're new, they're parts, et cetera. For dealerships, it's typically going to be those three pools, though, of inventory. It's going to be new vehicles, used vehicles, and parts. And new vehicles typically are on alternative LIFO, which is auto LIFO. Used vehicles, sometimes we see using used LIFO. We typically, for most of our clients, use a different method, and Brittany's going to talk about it on the next slide. But if you happen to be on used LIFO, that is an option. And for parts LIFO, that uses an internal index. If you are on auto LIFO, it's important to remember that you can't combine LIFO methods on your inventory. So if you are on new vehicle LIFO, you can't use IPIC for used or can't use IPIC for parts. You have to be on either all on an internal index, which is essentially what auto LIFO is, or all on IPIC.
All right, so we're going to talk just a little bit about used vehicles specifically and some potential opportunities that there might be to include this inventory in your LIFO calculation. So, generally speaking, most of our clients are not currently utilizing LIFO for their used vehicle inventory, but are instead using what we call the lower of cost or market approach, or LCM. Back in 2009, most dealers ended up terminating their used vehicle LIFO, uh, which was a result of large deflation on the used inventory at the time. The IRS allows the use of book to determine the replacement cost at year end for the lower of cost or market write down. So, in calculating the tax write down, we basically use an electronic VIN booking method, which will typically result in write downs on used vehicle inventory ranging anywhere from about 15 to 20% of inventory costs. Now, as most of you have seen, we are in very strange times as it relates to the value of used vehicle inventory. So rather than seeing, the similar write down percentages as what we've historically seen or would expect to see, we're actually finding that much lower write downs on 2021. So far on the calculations we've run internally for Moss Adams for 2021, we're seeing an average of around 4 to 12% for the current year write downs. Alternatively, in looking at used vehicle LIFO for 2021, we're actually seeing very high levels of inflation for all used vehicle makes. At this point, the estimated inflation for 2021 is around 18%. And for some manufacturers, like Chrysler, for example, their inflation rate is close to 35% at this point. If you are considering your expanding your LIFO election in 2021, it is still important to keep in mind that with these high inflation rates in the current year on used vehicles, there is still some concern that there may be dramatic reversals in the future as new vehicles do become available again to purchase. And we will walk through a case study that will kind of outline how this all works and what it looks like from a practical standpoint in just a couple more slides here. Before we get into that case study, though, just a quick update on how to actually make your initial LIFO election or expand your current LIFO election. So, a LIFO election or expansion is made by filing Form 970 with a timely filed tax return. Keep in mind, as Brianne mentioned, this does include extensions. So, generally speaking, for calendar tax payers, that would be either September 15th if you're an LLC or partnership or an S corporation, or 10/15 if you're a C corporation. And again, this does give taxpayers really the benefit of hindsight in making that election or expansion decision. And we'll reiterate just one more time, it is really important to go ahead and book your LIFO estimate when providing any financial statements to outside users, as this will protect the LIFO reserve possibility. So with that, I think we are going to actually walk through a case study, and I'm going to let Brianne take us through that.
Yeah. So as you're looking at your situation and looking at this potential recapture of your income and trying to decide what to do, there are a lot of things to consider. And so, doing nothing may be the right answer for you, to go ahead and recapture based on your reductions in inventory and then stay on LIFO, a regular auto LIFO, and know that you're going to potentially have great deductions coming to you in the next several years because of high inflation.
There are potential options to expand your LIFO election. If you, especially using IPIC, we saw this a lot with RV dealers. So especially last year, if they were on LIFO for their new inventory, but weren't including their used inventory in their LIFO, they were able to pull in their used and maybe even their parts to help mitigate some of the reductions in the used inventory, the new inventory that they had seen. So that is one method to help kind of mitigate some of these reductions. Keep in mind that historically, auto LIFO has had much better inflation than IPIC. We're seeing these pretty massive numbers when you look at the IPIC indexes, and those are based either on producer price indexes or consumer price indexes. they're really big right now, and so they're pretty appealing when you look at them. But those are typically pretty volatile. So they'll go up and they'll come right back down. So you're going to see deflation sometimes as well. So just keep in mind that auto LIFO typically has been a very reliable method because of the way the inflation has worked. Typically, manufacturers are increasing prices year over year on most models. So you'll see on average this really steady increase year over year, where IPIC can be just much harder to predict and isn't always going to just give you a steady increase. We have utilized a switch from auto LIFO to IPIC in the past to help preserve a reserve when there have been material errors in a prior calculation. So when we pick up a new client that's been on LIFO for years and years and years, and we review that calculation and we find that there's some really big error in the past that has artificially inflated the reserve, or some other issue in there that we're concerned about the reserve calculation, then we have decided, or presented the option to go ahead and switch to IPIC, and that inventory method change ends up preserving those old LIFO layers. And so it can be used when you have errors as well in the past. And if you are thinking about electing IPIC, you are required to stay on IPIC for 5 years before you can switch back to auto LIFO under an automatic change. So you could potentially use a non-automatic, but we're pretty sure the IRS is probably not going to look favorably upon people doing non-automatic changes when it's just for a tax reason. So if you switch to IPIC, you're probably stuck on it for the 5 years. And if you are thinking about doing IPIC for your used inventory, or even auto LIFO for your used inventory, rather than using something like the LCM method that Brittany was just talking about, you are going to have to pick up that income, or basically the reversal of that prior year deduction, over 3 years. So you're still going to end up, when you switch the methods, you don't get to just carry over that prior year LCM write down. You're going to have to pull it into income. And so this is an example that we wanted to use to illustrate some of the concepts that we've been talking about and some of the strategies we've been talking about. This in particular was a client that we worked with who had, they're an auto dealership. They were using auto LIFO for their new inventory. They were using the lower cost or market method for their used, and they happened to have pulled in some RV inventory. They were also selling RVs under the same entity in recent years. And leading up to 2021, they haven't had used any. They've been just on FIFO for their RV inventory and their parts. They've only been utilizing LIFO for their autos, for their new vehicles. So they were looking at a pretty significant pickup in income this year because of their reductions in inventory, and we have this illustrated here. So you can see that last year they had significant new and used vehicle inventory, still pretty good RV inventory. And then their LIFO reserve was about $1.4 million last year. And they had a really great lower cost or market write down last year, which we saw a lot last year, some pretty good write downs. And so we started talking to them about what their 2021 was going to look like. And running some estimates, they had such a significant decrease to their new vehicles that they were looking at a pickup of their LIFO reserve of about $1 million. So their reserve was going to decrease by $1 million. So that was going to be $1 million of income coming to them. Their used inventory also decreased, as you can see, by about $5 million. And that we were estimating was going to result in a reversal of the prior year deduction of about $2 million. So in total, they were looking at $3 million more of income coming in this year. And we wanted to try to look at this and see if there were any other approaches that we could take that would help mitigate some of this income that they're picking up. So the first scenario we looked at was, what if we elected IPIC for their new, used, and their RVs? So their RVs had previously had not been on any form of LIFO. We hadn't been doing write-downs for them at all. So pulling them in was a way to offset some of the decreases in the new and used inventory. So prior year, their LIFO reserve under the auto LIFO was $1.4 million. By pulling the RVs and the used into the calculation, we actually got an increase to the total LIFO reserve of about $2.2 million. So to go from having to pick up $3 million of income to a $2 million deduction, this looks great. The scenario is looking very appealing. The piece that they had to consider, though, is that previously they'd been using LCM for their use. So if we pull used up into the LIFO calculation, we can no longer use that method. And so that $3.5 million deduction they got last year, we're having to pull that into income now over 3 years. And so even though this year we're only pulling in 1/3 of it and getting to still a total net deduction, which again feels much better than $3 million of income, they also know that now that they still have another $2.3 million of income to pull in over the next 2 years. And again, if we're looking at those higher rate years, putting $2 million of income into 2022 and 2023 may not be the best option. So Britt, thank you. So the next scenario we looked at was, okay, well, that the impact of recognizing all the LCM income in 2021 wasn't great. We didn't it was definitely we needed to look at another situation to see if we could get them a little closer to where they wanted to be at. So the next scenario was to pull in the RV inventory in with the new auto inventory, and elect IPIC just for those two. And so when we did that, their LIFO reserve went from $1.4 million to $3.3 million. And so that got them a deduction of about $1.9 million current year LIFO deduction. And then the LCM, because their used inventory decreased so much, they definitely still are going to have a pickup in income. They definitely, this deduction is smaller this year than it was last year. So we're going to have to pick up some income. And so the net in this case ends up being only $200,000 of income. So again, not as much income under if they just continue what they're doing, but definitely more than the scenario one. And for these guys, looking at if we just looked at the current year, it's really obvious what the right answer. Scenario one makes the most sense. You're getting the biggest deduction this year, but we wanted to make sure that we're not looking at just the impact this year, that we're looking at out into the future and projecting out what could happen, because these methods, they do last for 5 years. You are stuck on some of these methods for a long time. So you want to make sure that any decisions you're making aren't just considering current year, and you're looking into the future. And so for these guys, I kind of alluded to it, the second scenario is what they want to do today. But we're going to keep looking at it. We've done this modeling and looked at this and talked about it. And today it feels like that scenario number 2 feels like the right answer for them specifically. But it may not be if if tax rates don't increase, if we realize that, we're really not looking at increases. So then does this still make the most sense? And if inflation changes, so if it looks like we have high inflation today, but it's not really going to continue increasing like we expect, or we think we're going to go towards deflationary times, then we would again want to re-look at this and reevaluate and to determine whether it was still the right answer. So they're planning to extend their tax return and to just keep watching these issues to see how it might affect their decision. And with all of this, this example was a very unique example. Not many auto dealers also happen to have RVs in their same entity that they hadn't been previously, including in a LIFO calculation. So this was a unique situation, but it did a good job of illustrating several of the issues that we've talked about. So it really just is very important to look at your own situation and to determine what is the best answer for you. Your LIFO is going to be different than any other dealer's LIFO. It's going to depend on how long you've been on LIFO. Has your inventory fluctuated significantly year over year, over time? There's all these things that impact your layer history and how much reserve you might be recapturing this year that you would want to consider. And in most cases, if you're considering doing something, some election for IPIC or use LIFO or whatever you're considering, most of the time you do have automatic method changes available. I mentioned earlier, there are non-automatic method changes available as well, but those are costly and not for sure. You could go ahead and try to get advanced consent and not end up getting it. And definitely be careful for the 5-year rule, because like I said earlier, once you've changed methods, in most cases, you're stuck on that method for 5 years. So decisions you're making today are going to affect your dealership going forward.
Awesome. Thanks, Brianne. So just a few more important items that we did want to touch on before we wrap up for today. First being, we highly recommend, especially this year, that you run your current year LIFO estimate through some type of software program. More often than not, what we do end up seeing for those who are solely using Excel templates is that it doesn't necessarily calculate years of decrement correctly. And so it is really important, especially given low inventory levels in the current year, that you are running that through some type of software program just to double check those numbers. And also, be sure that you are capturing all of your in transit vehicles in the LIFO calculation for 2021. What we've seen so far is that in transits this year are much higher than in previous years. So it's important to capture that in your ending inventory amounts. It's also important, though, to use caution in how you're actually identifying your in transit vehicles. So, to be considered an in transit, the risk of loss should have ultimately transferred to you as the end user as opposed to the manufacturer. And the vehicle should also have an invoice date of 12/31/2021 or earlier. So, just keep in mind vehicles that are on order aren't necessarily the same as vehicles in transit when completing the LIFO calculation. So I believe that gets us through the material that we wanted to cover for today. So, Rachel, I will turn it back over to you to close us out.
Brianne, Brittany, and Jack, thanks so much for this informative presentation. We always love having Moss Adams on and appreciate the way you break down all of this complicated information for us. To those on the line, you'll be receiving a copy of this webinar by the end of this week. For more information about AIADA, visit AIADA.org. Thanks for tuning in and have a great day, everyone.